Hello everyone, my name is Miti and together with my teammate Jayeeta we are going to present on the topic option pricing using Monte-Carlo simulation and value at risk analysis. It is known that the Black-Scholes model is extensively applied in calculating prices of European options which expire only at maturity. However, this widely acclaimed formula loses its significance when dealing with American options. American options differ from the European style options due to the right of early exercise of the option prior to its expiration date. Monte Carlo methods are ideal for pricing options where the payoff is path dependent or where the payoff is dependent on a basket of underlying assets rather than just a single asset. To give you all a brief introduction about Monte Carlo simulation, it is a computerized mathematical technique that furnishes the decision maker with a wide range of possible outcomes for any choice of action by running multiple trial runs. It builds models of possible results for any factor that has inherent uncertainty. The model calculates the results over and over using random values from probability distributions, producing a range of possible outcome values. The Monte Carlo method in finance is often used to evaluate investments in projects or to evaluate financial derivatives to value and analyze instruments, portfolios, and investments by simulating various sources of uncertainty affecting their value and then determining the distribution of their value over the range of resultant outcomes. Investors are often puzzled by the choice of exercising time of American options because there is always uncertainty over whether the underlying assets will go higher or lower in the future. Monte Carlo simulation is a great method to value American style options because, regardless of the future price of an individual option, we should be able to derive the expected return of exercising this American option early as long as we assume that the underlying asset's price will follow a log normal distribution. The goal of our project is to perform Monte Carlo simulation to price an American call option with the S&P 500 index as its underlying security. The objective is to simulate prices of the underlying for a period of 30 days or a month and assess all the possible steps and outcomes of asset pricing. We would also like to determine the impact of risk and conduct the value at risk analysis to allow for better decision making under uncertainty. One of the goals of our project is also to answer the question, what is the most expected loss with a 95% or 99% level of confidence? The first step is to list all the variables and input parameters, including the market factors for the call option under valuation. We then derive the expected return on exercising the option at any day before expiration date by simulating prices and the value at risk. We do this by constructing a Monte Carlo simulator for 1000 iterations to generate daily prices and calculate the payoffs. We ultimately get the intrinsic value of the option by discounting the average of the payoffs. The basic structure and process flow involves the input of valuation parameters, price paths, and market factors into the model. Then, using the Wiener process, also known as the Brownian motion, we calculate average exercise value or payoff for each price path. We then run the model simulation for 1000 iterations and finally price the option by discounting the average payoff. We use the geometric Brownian motion with a drift formula to simulate our asset price paths. The legend in the next slide provides a detailed explanation of what each symbol in the formula means. The legend here breaks down the formula and explains its components. For example, S0 refers to the stock price today or the spot price. S delta T is the value we are trying to find, that is the stock price that we would be simulating using Brownian motion. Mu and sigma refer to the expected return and expected volatility over the time period T, and epsilon refers to the random value sampled from the normal distribution. To make the scope of the project practical within the time frame, we have narrowed our analysis down to an American call option on the Standard & Poor 500 index with an expiration after 30 days. The S&P 500 is an index of 500 stocks chosen for market size, liquidity, and industry sector, and we collected data about the spot price, strike price, volatility, and the historical annualized return from Yahoo Finance, Bloomberg, Reuters using the ticker symbol GSBC. The next part of the presentation will be explained by my teammate Jayeeta.
Thank you, Miti. Hello, everyone. My name is Jayeeta and I will walk you through the Monte Carlo simulation run process. The first step of the process involves the construction of the Monte Carlo simulator for determining the terminal price of the underlying option. As we are interested in daily prices of the option until the date of its expiry, the interval or time length is 1 day. In our analysis, we have assumed that the option contract will expire after 30 days, so we have used 30 intermediate blocks to simulate the development of the prices using the Wiener's stock price evolution equation. Here, a random sample from a normal distribution is obtained in the model by normally scaling the random numbers generated using Excel's RAND function, that is normal inverse in bracket rand function. The process now needs to be repeated several times. We have used 1000 simulation runs in order to generate a time series dataset with data table functionality in Excel. In figure 1, we can see the simulated prices ranging from 1 to 1000 simulated runs for each date of the contract period. Once this process is done, we calculate an average terminal price time series by taking a simple average of the terminal prices at each future date across all the simulated runs. So, the average terminal price for date 1 is the average of all the terminal prices generated for this date across the 1000 simulated runs. Now for each data point given in the terminal price dataset, we now calculate the payoffs or intrinsic values of the option. We have a call option having a strike or exercise price of $900. The average payoffs for the option at each future date across all the simulated runs are calculated and shown in figure 2. The next step is for each data point given in the terminal price data set for which we have determined the payoffs. From this, we will now calculate their discounted values as follows. Here, we consider the actual time period of the option expiration, that is, capital T is equal to 30 days. With this, we determine the average price time series by taking a simple average of the prices at each future date. Now that we have the average price series, we will determine the return series by taking the natural logarithm of successive prices. Here, the formula runs as ln price 2 divided by price 1. Figure 4 illustrates the return series for the call option. Value at risk has been called the new science of risk management. This is the most popular and traditional measure of risk is volatility. For investors, risk is about the odds of losing money and VAR is based on this fact. By assuming investors care about the odds of a really big loss, VAR answers for us the question that is, what is my worst case scenario or how much could I lose in a really bad month? Monte Carlo simulation amounts to a black box generator of random outcomes. In our simulation, 100 trials were conducted. The red notations in the histogram shows the 5 worst outcomes among all the simulated trials. The Monte Carlo simulation therefore leads to the following VAR type conclusion that with 95% confidence interval, we do not expect to lose more than $127.14 during any given month. And for 99% confidence interval, we do not expect to lose more than $189.89 during any given month. Now, the 10-day holding period VAR at the different levels of confidence level is calculated and depicted in the graph to provide a better illustration to the investor about the movement of the VAR and how much risk he or she needs to take in order to make a profitable decision. We have also tried to put together a VBA code in Excel to automate the process. This helps to concisely put the simulation without showing each background complex steps. This serves more as an abstraction model for people using the model without detailed knowledge about the background information. Some of the major discussion points are as holding period of the option increases, volatility increases for VAR calculation for each day. This is because consider if we have current volatility and intend to simulate the price for the option after one day, it will give a very accurate estimation. As we use the same volatility rate for the next 30 days, accuracy tends to fall. This is because the market is a very dynamic environment with many changing forces influencing the trends. Also, return price series gives the percentage of return on the asset for each day of holding. The frequency distribution graph, which we just saw in the last slide, highlights the maximum frequency for price volatility rise within -4% to +3% and averages at 5.54%. Using the Monte Carlo technique, any asset can be priced even when no closed form solution is available for that method. So in the conclusion, we can discuss some of the following observations. From the return prices calculated as shown in the chart, we can say the analysis suggests that on the 13th day, the price return percentage is maximum on the portfolio, which is 11.414%. In case of an American call option, Monte Carlo simulation helps investor to realize each day's return prices and the exposure to risk. This helps in a better decision making model and we can ensure that it is generated similarly. Here, higher positive returns are marked in green, which shows that these are the ideal days for an investor to exercise the option before its expiration date. The 30-day holding VAR is a maximum at 99% CF. At 95%, $134.06 is the most expected loss. Limitations exists in every model. Some of the limitations for Monte Carlo method are volatility and interest rate are hard to extract from market data, continuously updated and influenced by market trends. Returns and inflation are treated as random since the whole Monte Carlo simulation is based on randomness. This process may not include fat-tailed nature of return distribution. From a modeling perspective, fat-tailed distributions are important when extreme events must be a part of the model. Also, it takes a high computing time and it tends to hang laptops, especially if they are old ones with low processing power. Some of the online sources of the background research are mentioned here. Also, we conducted a qualitative interview with two pricing analysts from a leading hedge fund company, the D.E. Shaw Group. It gave us the process knowledge and some great tips on handling huge option pricing data sets. We would like to thank Professor Linda Friedman and all our fellow classmates for your support, and we welcome any developmental feedbacks. Thank you.